Hey there, folks. Welcome back to Daily Crest. I'm Mercy, and today we've got an incredibly important topic to delve into. We're discussing China's current dilemma in managing its debt crisis. As you can see, we've got a lot to cover, so let's dive right in. To kick things off, take a look at this illustration of a Chinese 100 yuan bill with an unhappy Chairman Mao photo. Quite the symbolic image, isn't it? Now let's break down the situation. Beijing finds itself in a tight spot. On one hand, it's tempted to roll out more stimulus to keep its economy afloat. However, it's also aware that these government incentives fueled a real estate bubble that might just burst if not handled with care. The catch? Pulling back these incentives risks a deeper economic slowdown, potentially leading to social unrest. And folks, here's why this matters so much. China has been seeing weak economic data for a while now. If the financial and real estate sectors collapse, the country could be staring at a full-blown recession. But what's even more concerning is the possibility of a prolonged period of stagnation, similar to Japan's struggle in the 1990s. And brace yourselves, because a recession in China could send shockwaves throughout the global economy. Just a few days ago, China's central bank made a surprising move by cutting interest rates for the second time in 3 months. But despite this, analysts believe that stronger measures might not be on the horizon. They argue that Beijing actually wants to deflate the real estate sector, but is treading cautiously to avoid provoking social unrest. It's worth noting that protests erupted across more than 100 Chinese cities last year. Why? Mortgage owners were demanding developers to finish apartments they'd paid for, sometimes years in advance. These kinds of tensions illustrate the delicate balance that the Chinese government needs to maintain. To understand this issue fully, let's rewind a bit. Years of central government stimulus led to a flurry of infrastructure and real estate projects across China. This, in turn, drove rapid economic growth. But here's the catch. Local governments often financed these projects with loans, leading to significant debt. Now, with many developers deeply in debt themselves, the real estate bubble created by these policies seems to be on the verge of bursting. China's zero-COVID policy and government intervention in sectors like tech have dealt economic blows, driving down growth. Additionally, the threat of deflation looms, which can worsen debt-related issues. As our expert David Dollar puts it, deflation increases the real value of debt, making matters worse. So where do we go from here? Well, according to Louis Lau, a director of investments at Brandis Investment Partners, the real estate industry might remain in a state of life support for quite some time. That's a wrap for today's analysis, folks. China's balancing act between stimulating the economy and deflating the real estate bubble is a high-stakes game with global implications. Be sure to like and subscribe to Daily Crest for more insightful discussions like this one. I'm Mercy, signing off. Stay informed and stay curious.